Good afternoon. We can continue our discussion that we started last week, that is money supply process. And you probably got a kind of a feel in terms of how different players, particularly three stakeholders in the form of central banks, then financial intermediaries, mainly the banks, and then you see depositors. They influence the money supply process, and we looked at different a combination of how market responses influences both liability side and asset sides of central bank balance sheet, and subsequently how that contribute to the monetary base. If not high-powered money, and you know it is monetary base is nothing but the currency in circulation and the total reserves. And then we look at different open market options, open market purchase, open market sale, and then shifts from deposits into currency, and then central bank loaning to financial intermediaries, how these things affect the money supply process. But at the same time, apart from these open market operation, we also look at other factors that also affect the monetary base, and then of course we looked at this so-called monetary base could comprise of borrowed reserves too, and then we try to kind of split the monetary base into both non-borrowed and borrowed. And after all, we discussed to understand that both borrowed side as well as non-borrowed side positively related to the monetary base. And then we looked at so-called multiple deposit creation, where the banks, whenever they receive deposits, they have to maintain only a required reserves with the central bank, and on top of that required reserves, until such time depositors keep their savings or deposits with the bank, they could go on and create additional loans, and this process is the multiple deposit creation. And we looked at it with a kind of 10% required reserves scenario, and how reserves being influenced. And that's where, if I'm not mistaken, we have stopped our discussion, right? So then you see this multiple deposit creation process summarized to the extent in a table here. You can see here the increase in loans was basically 100 million, and this 100 million, right, being kept as a deposit. Okay, so then at 10% required reserves, 10% of 100 is 10, so that is the reserve requirement. At 10%, central bank monetary authority requests these banks to keep with the central bank from their deposit base. So what you are basically seeing is, when you have a 100 deposit, you require to keep only 10, the balance 90, until such time a depositor take out in the form of currency in circulation, you can loan it to another participant. So you basically create another loan that is 90, and this become another deposits, because when you loan to a client, you create a checkable deposits, as in the example. So you see the deposits also increases by 90, and then 10% of 90 is 9. That's the required reserves that the bank needs to keep with the central bank. So then you another 81 million left with you to give another loan. So this loan is again created as a deposit. So you require only 10% of this loan. So that is nothing but 8.1. So you leave with 72.9. So you can go on like this to create additional deposits from the initial loan itself. And this process continues until you see you have over and above your required resource in the deposits column. So you can tally the ultimate compilation. You can go on, I mean, as an exercise, you can go on till the value of deposits reach 0, and then you stop creating new deposits. But aggregating this, you will end up having increase in deposits to 1,000, increase in loans to same 1,000, but it's the 10% requirement of deposits that is 100,000 into 10% is 100. That's what the resource aggregate would be. So this is a process is known as simple multiple deposit creation model. So you could see this, and we can go on and elaborate this little more detail in the form of a formula. Before I move into this formula, any questions? Right. So you see this formula here. That's a simple deposit creation model formula. But remember, while I was explaining, I was very keen to say that, right? Central bank would continue to go on and create, not the central banks, the banks would continue to go on create the deposits as long as the customer maintains his deposits without withdrawing. That means he has not converted his checkable deposits into currency. At the same time, we here assume the banks also do not maintain anything other than the required resource with the central bank, right? So you see it is 10%, they keep 10 from 100 deposits. If it is 5%, only they keep 5, but not 6 or 12 when it was 10. So if you see any excess reserve, they maintain with the central bank. So by that amount, the available deposit value reduces, that excess, by that excess reserve amount reduces to go to the next deposit creation probability. So it is subjective in that sense. But you assume there is no excess reserve creation. Banks do not keep any excess reserves. So in such circumstances, right, so total reserves is always equals to required reserves plus excess reserves. Total reserves equals required reserves plus excess reserves. But when you see, you make this excess reserves to 0, so naturally what you left it in the equation is required resource equals total resource. So in the simple deposit creation formula, what you are basically seeing is there is no excess resource. Required resource is equal to total resource. But interestingly, you can figure it out required resource by looking at the required reserve ratio and the deposit amount. So it is nothing but, right, required reserve ratio times the deposit. And in this case, in this example, it is checkable deposits that we were discussing. So you know, a small r is given to recognize the ratio, and in the example it was 10%, right, times the total checkable deposit. And in the first instance of the example that we discussed, it was 100. Okay, and ratio was 10. You derived required ratio as 10. So you can again have this element where you can represent so-called reserves, where required reserves equal total reserves is nothing but small r times D. Required reserve ratio times the checkable deposits equal total reserves. Because in the simple formula, we have recognized required reserves is nothing but the total reserves, because we have taken out so-called excess reserve from the consideration. So we divide both sides by simple r. What you left with is D equals 1 over r times 1 over simple r, okay, required reserve ratio times r, that is total reserves. So taking change in both sides will result in any change in deposits would be nothing but 1 over r times change in reserves. Okay, so you have seen that in the a table that you have gone through in the previous one, right? So 1 over 10 into, right, change in reserves, right, here equals change in deposits. So you just see change in deposits, okay, at one point from 100 to 90, change in deposits. You can see the change in reserves from 10 to 9 and 1 over r, 1 over 10. So you automatically will get the answer in this formula, change as 10. So you can do it for different steps in this equation. Okay, so that's basically sets you some understanding in terms of how you can derive the required reserve and the total reserves. And in this instance, we make it as equal simply by taking out excess reserves. And you can understand the fact that reserves are nothing but the ratio times the deposits. So by dividing both sides by r, you can derive the equation deposits equals nothing but 1 over r times the reserves. So you saw in the previous example, this r that you are seeing is 100. This simple r is 10%. So 1 over 10% time r is the deposits. So you will derive 1 over r times 1 over simple r times r. Here this was 100. So 1 over 10% is 10 here. 10 times 100 is nothing but 1000. 1000 is the deposits, right? So you can see that kind of, juggle with these numbers compared to the previous slides details, or you can create different reserve ratio, not 10, you can make it 5 and do the exercise. You can have Excel sheet and you can work through to make yourself comfortable with that arrangement. So this is nothing but simple deposit creation formula. But interestingly, there are critics for this simple model. You already know some of them because we discussed. But what you now see is more formally, when you hold cash, the simple deposit creation model stops. Right? So when you saw that when you bank lend, create a loan, right? They create the checkable deposits. Okay, so the client, as soon as he withdraws this, there is no possibility that you can continue the deposit creation in the simple deposit creation model. So what you basically seeing is currency has no multiple deposit expansion possibilities, but anybody who withdraws cash from his deposits stops the process. And if he takes the full amount, it stops at that stage itself. If he takes half and leave half in his account, then the bank has to keep only the required reserve from that maintained deposits, the balance with him. If it is 50, from 50 he has to keep 10%, that is 5. Then he left with only 45 to continue the deposit creation. But when you sow 100, 10%, then it's 10 and you left with 90. So you can go on with 90. So you can see that. So what you're basically seeing is the critics argue holding cash stops the process, and it's very clear. Okay. And then other thing is, banks may not use all of their excess reserves to buy securities or make loans. From a bank's behavioral perspective also, we know that the simple model already kind of discounted out so-called excess reserves are not available. So that itself a critic. Generally, the banks keep a little lower than required reserves, smaller excess reserve. Okay. And what they do is this excess reserve amounts they would not spend to buy securities or make loans. Either you can make loans means from that excess resource you can still come back to the simple deposit creation model, because you create the loan, make a checkable deposits, then required reserves, balance is there, you can take on like that. But they don't use, even while you keep excess reserve, for this type of creation of new loans. They behaviorally oblige, if not kind of a practice, to keep a small excess reserve from the empirical evidence. Okay. So then other thing is, the model itself depends on so-called depositor's decision. That is, first to keep how much in the account or how much in the currency form, and bank's decision how much to be kept in excess reserve form. Because when you keep excess reserves, you find your simple deposit creation model would break down, right? So the money supply certainty, by how much the money supply changes, how many times, by what percentage, all would deviate based on depositor's decision or bank's decision in this process. So these are the critiques of the simple model that you just studied, right? So then we are continuing to recognize factors that determine the money supply process. So you see already there's a component called non-borrowed reserves. So you have looked at the non-borrowed component. You can see there's a component called non-borrowed monetary base. Okay. So changes in so-called non-borrowed monetary base, the money supply is positively related to non-borrowed. Any increase in non-borrowed monetary base would increase the money supply. So similarly, you all also know changes in borrowed reserves from the central bank. Here you see it's Fed, right? So anything that you borrowed from the central bank in the form of reserves also positively related to the money supply. So both non-borrowed and borrowed positively contribute to the money supply process. And similarly, required reserve ratio also contribute to money supply process. Changes in the required reserve ratio, if you increase the reserve ratio from 10 to 20, money supply process or the money supply would reduce. If you decrease, money supply will increase, because you have multiple deposit creation opportunities much larger when you reduce the statutory reserve ratio. So it is negatively related to the money supply, reserve ratio negatively related to the money supply process. So the currency holdings also negatively related to the money supply, simply because if you keep more in currency form, more quickly you break down the simple deposit, multiple deposit creation probabilities. So higher the currency holdings, lower the money supply probability, increase in money supply probability. You see, that is also negatively related. Then the excess reserves. So money supply is negatively related to the amount of excess reserves, because if the bank become risk averse and keep more in more than what is required in the reserves, right, they can see by that amount they will not be able to take new deposits created, or loaning possibilities being reduced. Whenever you loan, you create a checkable deposit, so you can go on by doing that. But see the factors which are positively related to determine the money supply, and factors that are negatively related to determine the money supply. So you have seen both borrowed reserves and non-borrowed positively related to the money supply, whereas the required reserve ratio, currency holdings, and excess reserves are negatively related to money supply. Anything increases of this negative would reduce the money supply process, right? Whereas anything increases in the form of borrowed or non-borrowed will increase the money supply. So you can recognize both positively related and negatively related elements that would help to reduce or increase money supply in this discussion. And what you are simply seeing here is much clearer presentation of the variables that you looked at, but you define here in the form of 3 participants in the money supply process. You see the central bank, you see the financial intermediaries, the banks, and depositors. Under central bank's control, you have variables which are non-borrowed and reserve ratio. These are the ones central bank has control of. Then you see the banks under whose control you have the borrowed reserves. How much to borrow is their decision. How much to keep in excess reserves is their decision. And then you see another variable that is under the control of depositors, how much to hold in currency form. So then you see the changes in this variable. We take everything as increasing, borrowed increasing, non-borrowed increasing, required reserve ratio increasing, excess reserves are increasing, currency holdings are increasing. That's the direction of this change variable. But you can see what is positively related, non-borrowed and borrowed, whereas required reserve ratio, excess reserves, and currency holdings are negatively related. And then you see the reasons for, right? So what you see is when you non-borrowed increases, money supply also increases, more monetary base for deposit creation. You have more monetary base there for the purpose of deposit creation, right? Similarly, when the currency holdings increases, money supply reduces, less multiple deposit expansion. So you can take everything that you learned for the last 5 or 6 slides and basically take this particular slide into your head and keep it for various purposes. That would be much more comfortable in terms of analyzing the process. But the equation and the ratios, things that you studied, you can experiment with your general work routines to make sure that you understand where the direction in terms of changes to the variables. Right, any question before I move into the money multiplier? Right. So you see here, now we are heading towards slightly more detailed form of money supply process by analyzing so-called money multiplier. Okay, so this multiplier that we are now looking at is nothing but is the amount of money that banks can generate with each unit of reserves. In this case, we just assume as dollars because it's US Fed Reserve. Each rupee of reserves. In Sri Lanka's case, you can define it like that. Okay, it's the amount of money that banks generate with each unit of reserves. So what you know, this reserve is the amount of deposits that the central bank requires banks to hold and not lend. Right? So the central banks require all the banks to maintain these reserves with the central bank, but they are not supposed to lend that. So that's why the banks keep this reserve amount with the central bank, and central bank compute this so-called reserve amount by looking at the total amount of deposit and the reserve ratio. You have already done small r times D. Small r is the required reserve ratio times D is the deposit. Then you can figure it out what is the required reserves. Okay. So for the easy understanding, you know already, we have defined already the monetary base, currency in circulation plus the reserves, C plus R. That's the monetary base. High-powered money in another way of explaining it. Now you define this money as currency plus checkable deposits and recognize it as M1 for easy understanding. Okay. So, so-called money supply, M, is, now we are trying to recognize it in the form of monetary base. You know what monetary base is. Okay. And small m, that is multiplier. So what you are trying now is to recognize the money supply is nothing but multiplier times, multiplier means money multiplier times the monetary base. You know what is money multiplier now. So we will take this for further clarity by deriving the money multiplier. Okay, so you assume, these are general assumptions, but this is empirically too, it's right. The desired holding of currency and excess reserves, ER, we just take excess reserves as ER, proportionally grow proportionally with checkable deposits. If you see the deposit base or the checkable deposits are increasing, the amount of currency holding also increases, the amount of excess reserves also increases. So currency holdings is under whose control? Depositors. Excess reserves under whose control? That's banks. So you looked at that in the chart that we discussed a little while ago. So you see this in relation with so-called checkable deposits. And you also know currency, total currency holdings divided by deposits. Okay, that means out of total deposits, how much you are keeping in currency form. If you take it into a ratio form, would be nothing but the currency ratio, and that is defined here as small c. So currency ratio, when you say currency ratio, how much currency being kept as a percentage of deposits. And we define this currency ratio as small c, which is nothing but C over D. Then you also see excess reserve ratio, which is small e, which is nothing but excess reserves ER over D. So you already know what is a required reserve ratio, right? Required reserves over D is required reserve ratio, small r. So now we looked at here both currency ratio and excess reserve ratio for us to further understand what is behind this a multiplier, that is small m. Okay, so then we move on. You know, we define total reserves as unequal to required reserves in the simple model. R equals to RR in our simple model, but we know that is not the reality, and that's not the actual circumstance, where the total reserves are not only the required reserves but also the excess reserves. Banks are often keep a small percentage in excess reserves. So with this required reserves RR and excess reserves, you can write down so-called total reserves R equals RR required reserves plus ER excess reserves. Right? So then you see here the total amount of required reserves. You already know, we defined in our previous slides, equals to nothing but required reserves ratio time the amount of checkable deposits. Required reserve ratio is small r, the checkable deposits is D. So small r times D is RR, required reserves. So now you know, you already have reserves equation, R equals RR plus ER, and then RR is nothing but small r times D. So you substitute this small r times D into reserves equation. Then you see R equals small r times D, that is required reserves, plus ER excess reserves. So always the central bank sets this small r or required reserve ratio less than 1. Actually, it would be set very close to 0, right? It's not, when you say less than 1, they would not set 0.9. That means 90%. Of 100 rupee deposits, you have to keep 90% with the central bank. 50%, no. They would be always looking at something like very closer to 0, 1%, 2%. It's towards the lower side of the equation. So central bank sets this required reserve ratio very close to 0, but technically less than 1. Now you know the required reserves as nothing but R times D, small r times D, and total reserves as nothing but required reserves plus excess reserves. And you then substitute this required reserve equation into total reserve equation, and you have now got up to that stage in this multiplier exercise. Then you already know about the monetary base, which is nothing but currency plus reserves, C plus R. And now you know what is R is. You learned in the previous slide. So now you replace that R with small r times D, required reserves, plus ER, that is excess reserves. So now you can write down the monetary base equation, which is nothing but the currency plus reserves, that is C plus small r times D plus ER. So this equation reveals the amount of the monetary base, MB, needed to support the existing amount of checkable deposits, that is D, currency, that is C, and excess reserves. Okay, before I move on, any questions? Right. So you see here the monetary base now being defined to reflect the reserves being disaggregated to both required reserves and excess reserves. Right. So you know the currency ratio, that is small c, C over D is a small c, currency ratio. From the currency ratio itself, you can derive the currency holdings, that is nothing but currency ratio times deposits, small c times deposits, D. And similarly, small e, excess reserve ratio, which is nothing but excess reserves, ER over D. From that, you can again derive excess reserves, that is nothing but small e ratio, excess reserve ratio times deposits. So you have currency ratio, excess reserve ratio, or from currency and excess reserves, you can define both ratios as well as the amounts, the volumes, when you have deposits with you, total deposits with you. So we now substitute the monetary base equation that we derived in the previous previous slide, we define so-called C. You know, C is currency, this one. In the previous slide, you remember, we had this component here. C plus R times, small r times D. Okay, this component, and ER. Now we come to the point where we define C also. C is nothing but this component. Small c, currency ratio time deposit. So we have monetary base here, that component defined. Currency is nothing but currency ratio time deposits. And you have already know required reserve is nothing but required reserve ratio times deposits, and excess reserves is nothing but, here excess reserve ER, here is nothing but excess reserve ratio times D. So we have now made this equation where one part of each segment represent a variable common to everyone. So we take common variable out, that is deposit. So what you are left with is monetary base equal small r, small e, and small c times deposits. This is nothing but required reserve ratio plus excess reserve ratio plus currency ratio times deposits is the monetary base. So you now do dividing the entire equation, both this side, monetary base side, and this side, left side and the right side of the equation, by the term which is in parenthesis, that is R plus E plus C. So if you divide MB by monetary base by R plus E plus C, you will end up with this component here, this component 1 over R plus E plus C times monetary base. But when you divide this side by this R plus E plus C, this cancel off. So you left only with deposits. So the monetary base equation now look like this. The deposits equals 1 over required reserve ratio plus excess reserve ratio plus currency ratio times monetary base. Okay, so you already know M. We have defined in the previous slide the money supply as deposits plus currency, right? D plus C, and we already know C as small c, currency ratio times deposits. So you can again replace this C with ratio times D. D plus small c, that is ratio, currency ratio times deposits, and take out these common variables out, 1 plus c times D. So 1 plus c times D is what you get for M here. Okay. So what you are doing here is now you are substituting again to derive this, and you are leaving out the money supply as nothing but 1 plus C over small r plus small e plus small c, that is all ratios. Here also you have the C ratio, that's currency ratio. Currency ratio represent both the numerator and denominator times monetary base. So you refer the slide that you were looking at, where we mentioned so-called M money supply as, let me take you back to that equation. I'll take you back to that slide here. Multiplier times monetary base. So you have now derived this small m, money multiplier. So that's what we were doing all this time. And this small m is this component. That is money multiplier that's been produced here. So here the money supply is nothing but money multiplier times monetary base. M equals small m times MB. Money supply is equals money multiplier times monetary base. And for your understanding, here you see some details in the form of all the numbers that you would be familiar with, but for a kind of a exercise. So let's assume so-called required reserve ratio, small r, as 10%. If you write 10%, you write it as 0.10. Just 0.1 is also fine. That is required reserve ratio. So currency in circulation, C, C is $400 billion in absolute value. So you know what is C is small c times currency ratio times deposits. And they have given deposits here, checkable deposits. Checkable deposits is 800. Currency in ratio is 400. So you can write an equation here. C equals nothing but small c times D. That means 400 equals small c times 800. I'm just telling you now because you can simplify later, right? So then you see currency in circulation in absolute value, checkable deposits in absolute value, and they have given excess reserves also in absolute value. I said they keep a small excess reserve. Okay, excess reserves is nothing but what? Small e times D. So when you see this 800 is D, 0.8 is not even a billion, less than $1 billion in absolute value is the excess reserve. Okay, 10% of this 800 required reserve ratio, you see it is 80 in absolute value. Here it is only 0.8 billion, not even 1 billion excess reserves, right? So you can compute those details because you know what is the equation here, and you have D here. You can easily calculate ratios for C, small c and small e, right? So that's what here they have done for your understanding. They have done here small c computed, small e computed. Small c, and you already know money supply, M1 we define in one of the equations there, right, as C plus D, currency in circulation plus checkable deposits. We defined in one of those slides. So you see C plus D, you have given absolute number here. You have the absolute number. So C is 400, D is 800. So money supply is here 1,200 billion, 1.2 trillion. Then you do this compilation to see what is this small c. Small c is currency ratio is C over D, 400 over 800. So it is nothing but 0.5 or 50%. So 50% of the deposits being held in the currency form in this exercise, in this economy. And then you also know what is the excess reserves in absolute value, that is 0.8 over deposits 800. That is small e, excess reserve ratio. So to define this excess reserve ratio, you do this excess reserves over D and see what this E is. This is nothing but 0.001, not even 1%. Okay, if it is 10%, it is 0.1. If it is 1%, it is 0.01. But 0.1%. Okay, that's why it is 0.001. So you know what is the multiplier equation is. That is nothing but 1 plus C, 1 plus C, 1 plus C, 0.05 over small r, that is 0.1, it is given here, plus small r plus small e, that is excess reserve ratio. Small r is required reserve ratio. And you derive the excess reserve ratio as 0.001. And then C, small c, currency ratio, that is 0.1. So what you are basically seeing is in the numerator 1 plus small c, that is 1.5, over denominator you have required reserve ratio plus excess reserve ratio plus currency ratio. Aggregating them, it is 0.601. So 1.5 over 0.6, right? You can derive the answer as 2.5. The multiplier is 2.5. And this multiplier, it reflects what it is, that small m times mb is money supply. What you basically see is it is 2.5 times into monetary base. That would be the money supply in the economy in a real sense than a simple model that we discussed, where the simple deposit multiplier you derived was much bigger. It's 10. Right? So what you basically see here is, although there is multiple expansion of deposits, assuming there is no currency holding, no excess reserve holding in the simple deposit multiplier, right? In reality, it's there. People hold here. It's half of the deposits are kept in currency form. So only half is left for deposit multiplication. But then from that also excess reserves also been kept. So all slow down the expansion of the monetary base. And that's why multiplier is smaller here than simple deposits multiplier you looked at there. Okay, simply because the deposits can have multiple deposits creation ability, but there is no such expansion for currency, right? When the currency ratio increases, like from 0.5 we derived here, if this is 500 over 800, this will be much higher, right? So then you find this gets smaller because C, it's increasing here. When C goes up here, it also increases here. So absolutely, increase in this side would make the multiplier to look bigger, but because it's the small c is also here in numerator, it's pulled down the weight. So it reduces the ability of further expansionary money supply possibility. So you see this in the equation. So this is very important for you to kind of, get hold of how the money supply process works from a very realistic perspective. And I really want you to kind of look at this and previous explanation in terms of deriving the small m and deriving to the extent where some of these numbers are given, but you take some examples of different numbers and try to derive it and try to interpret. Now you understand what is behind this entire exercise. So that's what application is. You require this application to recognize why monetary base is increasing, but money supply is not increasing as it used to be. And yes, at times of crisis, at times of pandemics, at times of uncertainties, at times of vulnerabilities, people hold more in currency form. So when they keep things more in currency form, it reduces the possibility of having multiple deposit creation, and banks also become less intensive in expanding their deposits, and they keep more in excess reserve. Right? So you can figure it out, reasoning behind why expansion is so slower than a kind of a straightforward simple multiplier arrangement that we discussed. So you see the details here, and we will look at some application. I always want what you learn to be applied and try to see how that's been reflected in economic activities across different times. So we see a Great Depression of 30s and how the money supply also behaved. And remember, at that time, there was no deposit insurance arrangement. I believe you learned, you know that FDIC, Federal Deposit Insurance Corporation, that we discussed all that. But during 1930s, when the banks were failing, okay, what happened is people started taking out their deposits, and they started keeping their deposits in currency form, and people not came to kind of banks in big way during that period, right? Because they all felt uncertainty, they all felt holding currency during that period, okay? And from the banker's perspective also, that is depositors' behavior. They kept more in currency. They started pulling out deposits. That's what the depositors did during the Great Depression. Or the banker's perspective, as I was mentioning, they had more in excess reserves. They kept more in excess reserves. Okay, and then of course during that period, for a relatively constant monetary base, Fed Reserve also did not change the monetary base much. The money supply decreased due to the fall of the money multiplier. Fall of the money multiplier. What is money multiplier? 1 plus C over small r plus small e plus small c. Okay, so you see here, small c would have gone up because of the depositor's behavior. Small e would have gone up because of bank's behavior. So what happened here is the equation, multiplier equation, get weighted more because of a bigger push from excess reserves that you are seeing here. So you may see graphs that explains this in an empirical way. And you see here the deposits of failed banks during that period, where the banks started kind of getting deposits at the early part of the 1930s, but then sharp fall here. The deposits have basically from close to 400 plus levels, it's crashing down to mid-20s. Millions of dollars are very big in 1930s. Okay, so then it started kind of a building up. Market gets a confidence to invest back in financial intermediaries. Bank failures were of a past by this time. But then all of a sudden again, people pulling out because the bank failures happen in that part of the world, in US. And then again, people start making deposits. Again fall. And it crashes almost to a zero by mid-1932. Early part of 1932. The deposits of failed commercial banks, really see the numbers there. You see, these are the numbers of failed banks, right? Right, the failures here, it's high, here it's high, here it's low. I have to say here the banks were operating well because people were not seeing bank failures. I explained previously in the other way, but it should be corrected to say that here the deposits of failed banks are reducing. That means fewer banks fail during this period. Here more banks fail at heights here, top heights here. So you see here the banking crisis and the deposits these banks held during that period. And then you very clearly see two important elements. One is the currency ratio, other one is the excess reserve ratio. The currency ratio is in the left hand axis and the excess reserve ratio is in the right hand axis. You see in black, that is excess reserve ratio. You see in blue, that is currency ratio. So the currency ratio at the beginning of 1930 was around, let's say, 17%, 17%. People keep much more in deposits than currency. But you see, by 1933, currency ratio almost hits about 40%, more than doubled. And then some reduction in currency ratio, but still about 32% from 16%, double. This is a span of like 2 years, 2.5 years. And then you see excess reserve ratio. I was telling you, they keep a very small excess reserve, E closer to 0. Here, E closer to 0. Then you see, by this time, they are keeping about 5% in excess reserves. 5%. This money is not working for them. But still they kept that in the central bank's books. Excess reserves. So you see here, beginning of the financial, the banking crisis, and then here, end of the banking crisis. All increase, both currency ratio and excess reserve ratio has increased. You can now compare this with recent financial crisis. We'll come to that. That's why I said this application is very, very important. You learn this in the more technical way and understand what is behind those, but applying them for decision making or understanding why this is happening is very important. Right? So then you see the other element, so-called monetary base and money supply. So we were mentioning the monetary base was reasonably stable all throughout this period. Here you see it's reasonably stable, not much deviation, $7 to $8 billion. That was the monetary base in early 1930s in US. And money supply is nothing but what? Small m multiplier times monetary base. Look like it's 26 when monetary base was about 7. Making it to 26, it's almost like 4 times, isn't it? So multiplier should be 4 by that, during that period. But you are seeing here, as the crisis worsens, banking crisis become quite common, you see the money supply is reducing. Money supply is heading south. Money supply is heading south. And from high 20s, it has come to high 19s. High 19. I mean, it's 19 billion. High. I mean, it's not necessarily seeing like money supply is increasing. So the base has not changed. From about 4 money multiplier is here with the kind of about 19 when the monetary base is about 7.5. It is slightly more than two times. Here it is almost 4 times. So you see, multiplier has become smaller. Multiplier becomes smaller during this period. So that's how you should be recognizing, understanding, and what basically drive this multiplier to become lower. And you see in the previous slide both small c and small e. Okay, so you are seeing this now, this circumstance. Now we are trying to apply this to the financial crisis of recent times, that is the global financial crisis in 2007, 2008, and 2009 period. What you are seeing here is very interesting. During the recent financial crisis, you will see in the figure that's coming up in the next slide, the monetary base more than tripled. The Great Depression, you see more stable monetary base. That also due to the lessons learned by policymakers from financial crisis and financial stresses in the past, and they understood during difficult times the policy authorities, particularly the central bank and the treasury, both fiscal and monetary policies, required to see how best they could accommodate. And therefore, they have basically facilitated expansion in their monetary base. And in US, the base has tripled as a result of their central bank Federal Reserve purchasing of assets, financial assets, and new lending facilities. That means borrowed resource. They're expanding borrowed resource to stem the financial crisis. And you will see the figure, the currency ratio during this period, and the excess reserve ratio, small c and small e, you will see those stuff here. We see from these details, the small c fell somewhat. I mean, at difficult times, people should have more in the form of currencies, but during this period, it's reduced. Right? In our money supply model that we now looked at, the reduction in small c would raise the multiplier, because you see denominator gets reduced, numerator also reduced because it's 1 plus c, but denominator that is 1 plus, not 1 plus c, what is underneath, that is r, small r plus small e plus small c, that get reduced. Okay, the money supply, because it increases the overall level of deposit expansion. However, the effect of decline in C currency ratio were entirely offset by the extraordinary rise in excess reserve ratio, E, because during this period, expanding monetary base has not helped to expand the new deposits. That means there is no necessarily a deposit expansion happen. Banks have increasingly kept those in excess reserves instead of extending them in new loans. New loans means you will create another checkable deposit. Unfortunately, that did not happen because of the uncertainty, economic uncertainty. Even the big corporates and new projects were not necessarily took off during this period. Everybody was uncertain. So the economic activities to some extent remained subdued, and you know that with growth hitting negative numbers during the financial crisis, recent global financial crisis. So you can see these numbers here. See the monetary base from about 800, it's hitting more than 2 trillion. It got closer to 3 times increasing. And money supply, M1, which was reasonably steady across 1.5 trillion level. So when you see here, in 2007, about 800 monetary base, M1 money supply is about 1.4. The multiplier is less than 2. It's about 1.8, I believe. If you look at these numbers and you look at this M1 as 1,400, and 1,400 equals small m times monetary base MB, which is 800 here. So you can put that to the equation and see here what you are basically seeing is monetary base is greater than money supply. So multiplier has actually reduced. Here it is 2 trillion. 1.5 or 1.6 equals 1.6 trillion equals small m times 2. That means the multiplier is in negative territory here. So it's a very, very interesting recognition why this excess reserves, which was almost zero, has basically hit the roof here. It has gone above 1% level in US during this period. It's very strange, but yes, all the money that was expanded by the US Fed Reserve, expansion in monetary base, basically left with banks' excess reserves. And the currency ratio, people also not necessarily panic to pulled out their deposits or keep most of the deposits in currency form during this period. The currency ratio also reduces. Because one thing is, now here you have deposit insurance arrangement. So you can confidently look at, like, anything happens to your deposits, you have the deposit insurance. So you are not panicked. Bank panics were not that significant during this period of time. So these are very interesting findings. Okay, so what you are seeing in these last two slides, last 3 slides, is further kind of explanation to some of the details that we have discussed in our previous open market operation, how it influences the money supply process and things like that. And this is also some explanation to the simple deposit multiplier, and then of course the money multiplier. So you can read this for your further understanding of this discussion. I'm not trying to kind of detail these two. These are very much explained in our discussion. So this basically sets you very much in line with how you can look at the money supply process and how the money supply process related application to the recent financial crisis and Great Depression, and compare what happened during that period and what happened during this period, why monetary base has not influenced the economic activities, why the economic activities not expanded during the financial crisis, why it was not expanded during Great Depression. There was no push by policymakers to expand the monetary base. All kind of, details that you can have it from this type of understanding. And this section is very, very important, not only for your understanding and application, but also for the exam. And give a kind of a real weight in your exercises of what you have discussed in terms of money supply process in our last 2 lectures. And I can move on. I can start a new section today. And any question if you have before I move on to start the discussion, and we can continue that discussion next week as well. Right.
So, excuse me. With regard to the current COVID situation, the money supply in Sri Lanka and other countries will have the same effect, or what kind of a scenario will it be?
Yes, it's a very interesting question as far as current economic circumstances are looked at. But interestingly, you have already seen a similar market panic, similar market development in the Great Financial Crisis, not the Great Depression, global financial crisis of 2007-9. But it is slightly different in the form of the excess reserves behavior and currency ratios behavior. Of course, the currency ratio, what you are now seeing here in US during the global financial crisis, has reduced. But during the COVID period, it was not necessarily increased, especially across advanced OECD countries. Why? People have already kind of, looked at their consumption expenditure and related payments through electronic and other related payment structures in today's context. You don't necessarily see people are carrying currency, and also to some extent at the initial stages of COVID-related pandemic, people were panicked. Even the carrying currency, exchanging currencies could carry the virus. So there's some reduction in currency ratio, particularly in advanced economies. But the behavior would be slightly different in emerging and frontier market economies, developing world. The currency ratios would have slightly increased, but not in major emerging economies, but generally across developing economies. The reasons could have been still the kind of a payment structures that they are seeing is not that strong, but one could really see those numbers in coming periods. Still, you don't necessarily see global numbers available in terms of last 6 months or so. But generally, we also see some increase in currency in circulation, but not to the extent, because one reason is to some extent you are familiar with electronic payment structures during this period. But excess reserves, yes, there is a push in the form of expanding monetary bases all across the world, including advanced economies during this COVID-19 period. They have expanded, and you probably you can see, you can listen to all efforts by US, Europe, and Japan, China, East Asia, Sri Lanka, even India. You can see all the central banks have expanded their monetary base. They have either directly lent it to the stakeholders or purchased government papers to build this monetary base, right? A monetary base would have expanded for sure across all these countries, but some reduction in multiplier is possible because not much transactions across economies were noted, partly contributing to this increase in excess reserves maintained by banks. That is also one possibility during this period. So from a different perspective, there should not be much of a difference to what you are seeing in global financial crisis period and the COVID-19 period. But COVID-19 period, what we are simply seeing is it was much more health related, but how contributed across the world in terms of expanding monetary bases, because of central banks all around the world started accommodating their monetary policy stance. They started buying, they have started injecting liquidity, they have started provisioning loans. All facilities were extended and expanded. And you also see to some extent people have become little more conservative in terms of expanding economic activity. So the banks would have seen some reduction in loan creation, that means deposit expansion. As a result, excess reserves also would have been increased during this period. And currency ratios, we have not necessarily seen much of a change, because now throughout the world, you see electronic payments are quite popular. So you don't need to necessarily carry, but at the same time, people's income sources also decline. So they would not necessarily have regular incomes coming into their deposits. So deposits also would have slightly kind of, paled out during this period. So that's very much a possibility in the COVID setup. Any further questions? Right. So we see this development in the form of the money supply details that we discussed. So I'm just trying to kind of, initiate the next discussion. That is also very important, because this is more or less the kind of, explanation that you will get in terms of how and what tools central bank use in influencing the money supply, or for that matter, the cost of finance in the form of interest rates in the economy, right? And in previous sections that we discussed, when we describing the structure of Fed Reserve and money supply process that we just concluded, okay, we in and of highlighted 3 policy tools. Okay, these are conventional monetary policy tools. Non-conventional, yes, it's there. The central banks all across the world started using these non-conventional instruments, especially during periods of crisis, right? And we will come back to those. But these conventional policy tools I started discussing when we were discussing very much the Fed Reserve System and the Central Bank of Sri Lanka, some details. And also in the money supply discussion, we defined some of these here and there. So what you are basically seeing here is these conventional monetary policy tools can be used, and how the central banks use them to make adjustments and the movements in so-called money supply process, as well as the cost of financing, particularly the interest rates. And today's context, often the economies are little more and at times more keen to see these interest rates being derived rather than the quantum of money, the money available in the economy being adjusted, because variables like excess reserves would not necessarily pushing economic activities irrespective of increasing the quantum of money available in the economy. But then the interest rates also would not necessarily push in such circumstances the economic activities, because you see this the entirety of this the reviving economic activities by having accommodative monetary policies would also now link with non-conventional elements, where you require to bring in the confidence and certainty in terms of the direction of the economic activities. So the conventional tools that you will see in money supply and monetary policy processes are mainly the open market operation, you already know, OMO, okay, which basically influence the quantity of reserves and the monetary base, as you have very clearly seen in terms of our discussions, okay. And then the discount lending, right, which also affect the monetary base. And then you see the reserve requirement. Okay, this is small r that we were looking at. So mainly the statutory reserve requirement in the case of Sri Lanka. Other countries might be use required reserves. Some countries use statutory reserves. So in the case of Sri Lanka, we call it statutory reserve requirement, SRR, which is now stands at 2% in comparison to the levels of some other countries where were higher, but mostly it's closer to zero side, not up closer to 1. One is complete entirety of your deposits required to be kept in required reserves. Okay, so this required resource affects money multiplier. You know that in the equation. Okay, then you see here these tools being used by these central banks to impact interest rates and economic activity, as I was mentioning. It is also important to understand how the central banks wields them in practice, how they use them in practice, and how useful them in kind of energizing economic activities or driving economic activities in the desired direction of the policies. And you can see in recent years, the central banks, particularly the Fed Reserve, has increased its focus on the interest rate, as I have touched upon briefly. Okay, the federal fund rate, that is the interest rate on overnight loans of reserves from one bank to the other. Now, federal fund rate is the one they use in US. That is the overnight lending rate of one bank to the other in US. In Sri Lanka, it is the call money rate. Okay, so in the Sri Lankan market, you see it is call money rate. The banks lend to another bank, and the call money transaction happens often without underlying collateral. So they have limits also. Underlying collateral, they don't take any underlying collateral, so they don't open-ended lending also not facilitated under the call money transactions. So they have limits between their such banking activities, but central banks would target this overnight lending rate in today's context much more seriously than how they were looking at the interest rates in the past. Okay, so this in the US case, the Fed fund rate remains as the primary indicator of the stance of the monetary policy, and they set this on a periodic basis, and they review this on a regular basis. But since February 1994, the Federal Reserve announces this Fed fund rate target at each FOMC meeting. 8 of such, but or more frequently. And sometimes they maintain the level, sometimes they increase or decrease, depends on the economic direction. And this announcement is watched and followed closely by market participants because it's impact the interest rates throughout the world. It's not only US interest rates, but throughout the world, it influences in today's context. That to fully understand how the central bank, Federal Reserve, uses these tools, uses conventional monetary policy tools that we were talking in the conduct of monetary policy, we must understand not only their effect on money supply processes, but their direct effect on the interest rates, not only the overnight interest rate, Fed fund rate that we are looking at, they are now looking even beyond that, and we will discuss those stuff in our discussion. Okay, so this section that we are looking at, I would not take this last para being discussed because you probably see that's the setting for the discussion of the entire lecture that we are looking forward for the next week. So I will stop at this point for today. So if you have any questions, you can raise it. If not, we can take it up where we have stopped today in our next discussion. Okay, thank you.